Today on Equal Ground Markets, we are stepping back from the day-to-day noise and looking at what just happened to global markets in mid-November and why investors suddenly seem nervous about the same AI boom that sent stocks to record highs only weeks ago. We are recording this for Sunday, November 16th, 2025. After a rough stretch on Wall Street, a record run in gold, and big questions about where interest rates go next. Let's start with the shock that hit U.S. stocks this past Thursday. For most of this year, the story has been simple. Artificial intelligence drove the market. A small group of giant tech names carried the major indexes higher. Companies tied to AI chips, AI data centers, and AI software saw their share prices explode. Then Thursday happened. The S&P 500 dropped almost 2% in a single session. The Dow Jones lost almost 800 points. The Nasdaq, which is packed with tech names, fell even more. The selling was sharpest in the same AI darlings that had led on the way up. Shares of Nvidia slid several percent. Supermicrocomputer, a server maker that had become a symbol of the AI trade, fell even more. Palantir, Broadcom, and other AI-linked stocks were also hit hard. Traders were not reacting to one piece of bad news. They were reacting to a feeling. The feeling that AI valuations might have gone too far, too fast. For months, analysts have warned that the move in mega-cap tech was starting to look like the dot-com bubble of the late 1990s. Great companies, but priced for perfection. As long as interest rate cuts looked certain and earnings kept beating expectations, the market was willing to ignore those warnings. Now both of those supports look shakier. Which brings us to the second piece of this story: the Federal Reserve and interest rates. Through early autumn, investors were almost sure the Fed would cut rates in December. That faith helped push both stocks and bonds higher. Cheaper money means higher valuations, at least on paper. Then the 43-day U.S. government shutdown scrambled the data pipeline. Key economic reports were delayed or paused. At the same time, several Fed officials started to push back gently against the idea that cuts were guaranteed. In the last week, the market-based odds of a December rate cut dropped from a strong consensus to something much closer to a coin flip. When the world's most important central bank suddenly looks less predictable, every expensive asset starts to wobble. High stocks were simply the tallest trees in the forest when the wind picked up. But while tech was stumbling, another part of the market was quietly flexing its muscles. The Dow, which skews toward older economy names, has been outperforming the tech-heavy Nasdaq. Some strategists now think the Dow could reach 50,000 by the end of the year if this rotation continues. What is driving that shift? First, fatigue. Gaunt. Fatigue. After 2 years of hearing that AI will change everything, some investors are looking for more boring, reliable cash flows. Second, valuation torque. Traditional sectors like healthcare, industrials, and materials did not run up as violently as AI names. When money rotates out of one trade, it has to go somewhere. Lately, that somewhere has been dividend payers and companies tied to the real economy. Third, defensive positioning. If you are worried that the Fed might delay rate cuts, that inflation could stay sticky, or that growth might slow in 2026, owning a basket of mega-cap tech at nosebleed valuations starts to feel risky. Owning an index like the Dow, with more banks, drug makers, and consumer staples, can feel a little safer. Now let us talk about the metal that has quietly been screaming stress all year: gold. In mid-November, gold pushed above $4,200 an ounce and briefly tested its all-time highs again. That is part of a huge move this year. With prices up more than 50% since January, and having set a record above $4,300 in October. Why is gold, which does not produce cash flow or profits, suddenly the star of the show? There are several forces at work. First, interest rate expectations. If investors believe the Fed will eventually have to cut rates to support growth, the opportunity cost of holding gold goes down. You are not giving up as much yield by owning a metal instead of a bond. Second, currency worries. With U.S. debt levels high and the shutdown drama fresh in everyone's mind, some big players, including central banks, have been buying gold as a hedge against long-term dollar risk. Third, geopolitical tension. Coming from Eastern Europe to the Middle East to the Pacific, the world has not gotten calmer in 2025. Gold is still the classic, just-in-case asset when headlines look scary. Finally, the psychology of momentum. Once an asset starts breaking records, people notice. Retail interest picks up. Exchange-traded funds that hold gold see more inflows. That demand can add fuel to the rally, regardless of the fundamentals. Of course, not everyone is convinced this is healthy. Some analysts warn that if gold keeps outrunning stocks at this pace, it could be drifting into bubble territory of its own. But for now, the trend is clear. In a year of record AI profits and record stock prices, a lot of quiet, cautious money has been flowing into a metal that has been around since ancient times. So we have three big threads running through markets as of mid-November. Number 1. A sudden reality check for AI leaders and high-growth tech after a long euphoric run. Number 2. A rotation toward more traditional sectors and Dow-style names, as investors look for stability and income. Number 3. A powerful bull market in gold, driven by a mix of rate expectations, currency fears, and geopolitical stress. Over all of this hangs the question of what the Fed will actually do in December and into 2026. If inflation data comes in softer and the delayed government reports confirm a cooling economy, rate cuts could still happen on schedule. That would comfort equity investors and could even reignite parts of the AI trade. If, on the other hand, inflation refuses to cooperate or growth reaccelerates, the Fed might hold rates higher for longer. That would pressure expensive tech stocks and likely keep gold in demand as a hedge. We also have a busy stretch of corporate earnings ahead. Companies like Nvidia, Walmart, Target, Home Depot, and the major big box retailers are all reporting. Their guidance will tell us how much of the AI demand story is still intact and how healthy the U.S. consumer really is heading into the holiday season. At the same time, overseas markets are sending their own signals. In the United Kingdom, for example, demand for inflation-linked government bonds just hit a record, even as the FTSE 100 index climbed to an all-time high on hopes of future Bank of England rate cuts. That mix of strong risk appetite and strong demand for inflation protection looks very familiar to anyone watching U.S. markets. In emerging markets, countries like South Africa are making big policy moves, such as lowering their inflation targets to encourage long-term growth. That can change where global investors see opportunity in bonds and currencies. So what does all of this mean if you are an individual investor trying to make sense of November 2025? First, recognize that volatility is not a bug in this phase of the cycle. It is a feature. When valuations are high, small shifts in interest rate expectations can cause outsized moves in prices. Second, understand that leadership can change faster than most people expect. The fact that AI megacaps led the way up does not guarantee they will lead the next phase. Rotations like we are starting to see into value, dividends, and non-tech sectors can last months or years. Third, remember that hedges are not just for hedge funds. Whether it is gold, high-quality bonds, or simply keeping a cash buffer, having something in the portfolio that behaves differently from growth stocks can help you ride out sharp sell-offs without panicking. And finally, be careful about chasing the latest story, whether it is an AI breakout, a gold spike, or a viral meme about Dow 50,000. The underlying forces that matter most are still the old familiar ones: earnings, employment, inflation, and central bank policy. On equal ground markets, our goal is not to tell you which short-term trade to make. It is to help you see how these narratives fit together, so you can make decisions that match your time horizon and your risk tolerance. Right now, the narrative is this: we are in a market that is still broadly upward trending, but increasingly selective. The easy money in the first wave of the AI boom may be behind us. The next phase will likely reward investors who can balance growth stories with real cash flow, and who can stay calm when a single headline wipes a couple of % off the indexes in one afternoon. We will keep tracking the data, the Fed, and the earnings reports as they come in this week. For now, the message from mid-November is clear. The AI party is not over, but the lights just came up a little. The Dow is reminding people that old economy names are still here, and gold, shining above $4,200 an ounce, is telling us that under all the optimism, there is still a deep current of caution in global markets.